Hey, what's up? My name is Torlando Hakes, and I am with Craftsman Painter. And here we are ready to do another sprint seminar. Today, we are talking about business cash flow. So let's set up the agenda real quick and talk about what we've got coming up. So the first thing is that we're going to go over our collective principles. Then we're going to do a short segment on leveling up. We're going to talk a little bit about floor protection. Then we're going to jump right into the business seminar and cash flow. The reason that I'm adding these first two, the collective principles, is because what I've noticed is that as I share our collective principles with our customers, they've been really impressed by them, and it feels meaningful to them. And so I just want to share these principles with you and invite you into the Craftsman Painter culture and community. Next, we're going to do the level up because I want all of my people to understand how it is that we do the work. I mean, doing the work, that is everything. It is everything that matters in this business. Everybody wants to, the business consultants and gurus, different ones, they want to say, oh, marketing, you're just a painting company that happens, or you're just a marketing company that happens to paint. I don't believe that. We're a painting company first and foremost. Or at least our collective members, we're craftsmen, and so we got to talk about the craft, and we're going to do this in bite-sized chunks. So we're going to jump through those things, and I hope you enjoy them. So first off, let's talk about the mission of Craftsman Painter, which is to make a difference in the lives of our customers, neighborhoods, and community of craftsmen. Making a difference in the lives of our customers, so important. I mean, from the experience that they're having, to the color that's putting in the wall, to to their feeling about who they are and what their life has become as a result of customizing their home and making it their own. We truly make a difference with what we're doing. And because we're beautifying our neighborhoods and maintaining them, we're making a difference there. But hopefully, we keep it going, we extend it as we network and engage in community events, that we're making a difference and we're lifting where we stand. And finally, we want to make a difference in our community of craftsmen by helping you be a little bit smarter, helping you look a little bit better out there with your with the branding and the posh gear, making you true professionals. So that's our mission statement. Key characteristics of a craftsman painter is to be fearlessly authentic, spread kindness like confetti, and don't stop until you're proud. If that's you, you might want to be a part of our team. Critical actions: do the work right. Do it right. Do it the first time. Be conscientious of time, quality, and cleanliness, and level up every day. And today, when we talk about our level up, we're going to be really talking about that conscientiousness of cleanliness. Our brand theme is painting makes a difference. Let's level it up. Here we go. Floor covering. The thing about the floor covering is that you need to do this first. You need to do this first before you do everything. And there are two parts to it. One is that obviously we want to protect the surfaces of the client. But the second thing is that the way that we cover their belongings, it's part of the overall experience that we're providing. As you could imagine, if you're a person and you're spending thousands of dollars on a project, and you go in and your floors aren't covered, your furniture isn't covered, you don't, the top, your countertops and things like that. If it's not covered, and we're working in that space, that's anxiety bells just triggering off. It's like, oh my gosh, are they going to get paint on it? And look, I know that you're careful. I know that you're good at what you do. Okay, I know that you've got techniques that means you're not going to spill. But the reality is that your customer doesn't know that. And so by giving them the assurance that everything is covered, you're amplifying this experience, making it 100 times better than it was, just by doing the simple act of covering everything before you begin. So let's talk about the process flow for that. Well, I say if we're gonna level up, we better level it up. I think drop costs are not enough. Okay, dropping the entire room, that's what the competition does. okay? But we want to level it up, okay? So here's what I'm thinking. If we're in a carpeted area, I would recommend getting the thick, like 6 mil, the real thick plastic, okay? And start, over time building up an inventory of different size sheets so that you can cover the entire, square footage of the floor. You got a 11 by 12 room, cut an 11 by 12 sheet, make it just a little bit shorter, maybe, cut back an inch or so, and then take a Sharpie and mark it as an 11 by 12. You got a 10 by 8 room, cut it perfectly, mark it as an 8 by 10. What you're going to do is you're going to lay that plastic down, and that will work, I think, for carpet and hardwood. What I like about laying the plastic down is that if instead of like a drop cloth or paper alone, because if you spill paint and it seeps through that paper or through that drop cloth, it's still going to get on the carpet or hardwood floor. And so let's put the plastic down first and make sure that it is a seal that no liquid is going to transfer through. Then what we're going to do on top of the plastic is, for hardwood, put down the paper. Put down paper all the time. Always put down the paper. Okay, put down the paper, drop the entire room. Do that first. Get efficient at it. You're going to look so good. And by the way, when you take videos of your work, people are watching. People are seeing how well you are taking care of their services. And so put the paper down, cover every square inch. If you're on carpet, I would say that your drop cloths are going to be okay. Okay, we got the plastic down, put the drop cloths, I'm okay with that. Tape it down. If with furniture, let's do the 0.3 mil, spread it over everything, tape it down to the floor so that there's no chance that paint or dust is going to get in there. We're not just worried about paint, we're also worried about dust, okay? So that's the flow. Do that first, make it look pristine, get good at it, get efficient at it, and I'm telling you, your customers are going to be like, "Oh my gosh, wow. You guys really took care of my house." They're going to feel so good that you have done the work to cover everything, that the rest of the job is going to be smooth sailing. So that's how you level up with your floor covering. All right, let's talk about business cash flow. Business cash flow. All right, so there's a little model, and if you watched the personal cash flow video, which I recommend doing because we put it out 2 weeks ago, I recommend watching that. Prerequisite to this really, because the personal finances gives you an idea of how much money you need to extract from your business. Okay, so in business, we're using the same bucket system. We got the three primary buckets, the cash flow, and then the two additional ones. Okay, the difference is how we name them. So in this, how we're naming them is the money coming in as our revenue. That first bucket is COGS, COGS, cost of goods sold. That's your labor and materials. We'll talk more about that. The second bucket is OpEx, your operating expenses. The third bucket is the Spackle, and then from there you've got your free cash flow. But what happens to that cash flow is that a percentage of it is going to go towards tax reserves, because all that free cash flow, that's all considered your net profit, and you're going to be taxed on your net profit. And so we're going to allocate a percentage of that cash flow to a taxes bucket, and then the remaining can be our net profit. Now, net profit isn't as simple as the money left over that we get to take home. A lot of people confuse that and they get themselves into trouble. These two buckets right here, the taxes and the net profit, people get themselves into trouble with that because they don't understand that once you have the money cash, the cash flow coming through, it's not all yours yet. Okay, it's not your income yet. So let's talk a little bit about the difference between the cost of goods sold and the operating expenses. The cost of goods sold are variable costs. These are costs that are tied to your sales. They increase and they decrease when you have more sales or less sales. You sell a paint job and you've got expenses. You got labor costs and you got paint costs. You don't sell a paint job, obviously you don't have them. The thing about the fixed cost, though, is that as sales increase, your fixed costs become a smaller part of the cost structure. So if we look at this diagram here on the y-axis here, we have cost as a percentage of sales. Okay, so your variable costs are always going to be flat and steady, right? Because your variable costs ideally are a percentage of of the overall bill of your cost of your company, right? Your team has a certain prediction rate. Folks who are partnering with other collective members or using subcontractors, you might be giving a straight percentage of the job, and so your variable costs are directly tied to those sales, and they remain a more fixed. That's the kind of the dichotomy here, is that they actually remain a more fixed percentage of your total picture, um, and it's really just according to the sales. So your variable costs are actually going to follow your sales. So if you have steady sales, if your sales are the same throughout the year, then they're going to be flat. Now, if your sales are different throughout the year, your variable costs are going to follow that curve of the sales. Whereas the more sales you have, and you can see on the x-axis, we have it going, from this side to this side, right? Or from this side to this side, we have it. The more sales you make, the lower percentage of your cost structure, your fixed costs become. This is why revenue matters, because consistent revenue allows you to maintain fixed overhead expenses, easier. And so what you'll see in a lot of different companies, the larger companies that do a lot of revenue, they tend to add on fixed costs to their cost structure to allow them to delegate responsibilities, to allow them to hire different roles, to essentially remove some of the day-to-day tasks off of their off of their shoulders, so that they have time to do other things like focus on strategy, team building, mentoring, coaching, being in the community, increasing sales, right? There's a danger to that, though, because we are in a seasonal business, and sometimes when the sales drop, and you have a ton of fixed costs that you're responsible for, like, look, those fixed costs, they don't care about your sales volume, okay? So I say that it is important to keep fixed costs low to help you avoid cash flow constraints. So let's jump into the nitty gritty on these things. So COGS are the labor and materials for the job. If you don't pay your people or the paint store, you can't keep going. That money isn't yours, and so we keep it in a distinct account where the money in that account is reserved for people and paint. It's a variable expense, which means that it goes up and down with sales volume. You've got a lot of jobs. It means that you got a lot of labor and materials. No jobs, no labor and material. That's variable. So we're good with variable expenses. I don't mind variable expenses at all, because if we have a variable expense, that means that we're selling jobs. If our only expenses were tied directly to the job, that would make business so much easier. Now, this expense, it is your highest priority in your business. You want to make sure that you have enough cash in your COGS account to pay for a handful of sprints. Now, a sprint, and I recommend going back, and if you haven't watched the Sprint OS video, I recommend you watching that. A sprint is a 2-week pay period. 2 to 3 sprints worth is fine for residential. If you have 2 to 3 sprints worth of cost of goods sold, that's fine for residential. If you do new or if you do commercial, you'll want 4 to 6 sprints worth, because those jobs usually have longer payment terms, like net 30 or net 60. Now, one tip I would say, if you're in commercial or new construction, in order to speed up the payment, I would offer a deal like 210 net 30 or 310 net 60. That means that the contractor or the property manager that's paying you, that they'll get a 2% or 3% discount if they pay within 10 days, but after 10 days it's a full rate. So that can kind of incentivize them to pay a little quicker. You might get a few GCs that will do that, and that might be nice. Maybe accounts payable office might pay it off with a little incentive there. Now, the operating expenses account, or OpEx, this is for your fixed overhead expenses, and is first and foremost meant to cover payroll for admin and the owner. In other words, any employee whose salary isn't directly tied to commission or labor hours. So after you've filled the COGS account to the number of sprints, then you start pouring the remaining amount, which managerial accountants call the contribution margin. You pour that remaining amount of money into the OpEx account until you've got about 3 to 6 months of expenses taken care of. As you're working on filling the COGS first, though, make sure that you're paying attention to the business cash flow calendar, just like we did in the personal cash flow system, having a business specific calendar that shows when certain expenses are coming out, when paydays and when cash is coming in, when you expect jobs to be completed, and when the customer is going to pay. We want to know what the cash flow convergence is. When is the money coming in? When is the money going out? A calendar is a great way to do that. So as you're working through this, pay attention to that business cash flow calendar. You'll have to pay the urgent bills with the contribution margin remaining after COGS, but the goal is to have enough profitability so that you can start building that operating expense reserve. These expenses, the operating expenses, include your office expenses, like the utilities if you have a shop, or even if you have a home office, a percentage of your bills can be allocated as a business expense. The government lets you count a portion of that, so just keep that in mind if you don't know that already. Tools, equipment, vehicle expenses, they're part of the fixed overhead. Keep in mind that doesn't include your loan payment. So if you've got like a car loan, it only counts as an expense if it's a lease. Loans aren't counted; they're counted as debt, and business debts are paid out of the net profit, unfortunately. That makes things a little confusing if you're looking at a P&L, because your loan payments aren't reflected on the profit and loss statement. You actually find that in the statement of cash flows, and that's what trips up a lot of business owners who don't have that financial accounting background, is that they see that net profit and they think it's all flowing to them. Well, if you've got business debt, you're paying that debt out of the net profit. Okay, so it's a little bit misleading there, but just make sure that you understand that if you're paying off debt, that you are paying that out of the profit. If you have professional services like a CPA, bookkeeper, insurance, consultants, those kind of things, those come out of operating expenses. Okay, marketing and sales commissions, is that an operating expense? Well, hard to say. Technically, yes. However, they have a variable nature to them. Depending on how you look at them, or depending on how you issue a commission, or even depending on how you allocate marketing budget. When I'm allocating marketing budget, I tend to pull a percentage of the job to make it feel a little bit more like a variable expense. Instead of saying, okay, I'm going to dedicate 500, 1,000, 5,000, 10,000, $20,000 a month towards marketing, I'm going to say, okay, I'm going to take the money that I'm receiving from these jobs and apply it to my marketing budget for the next period. And that allows me to, adjust on a variable basis. But that does limit me in terms of which, marketing avenues I can go down. I can only go down the ones that have either one-time cost, maybe I buy a bunch of flyers, or the ones that you can, shut on, turn on and turn off like a faucet, like your Facebook ads and your Google ads. So, for what ends up happening to me is I just end up not working with agencies because the agencies all want a fixed, monthly expense, and I'm like, well, that doesn't fit my model, right? So I have to learn this stuff on my own and figure it out on my own. That is, of course, unless I have the revenue structure to afford somebody a salary in house, or I have the revenue structure to afford, that consistent. And that's again where revenue comes in play. The more revenue you have, the higher cost structure you can afford to have. So yeah, is marketing an operating expense? Technically, yes, but they can have a variable nature. Um, I would say that commissions could be counted as COGS. Like you could do some things in your chart of accounts to make it set up like that. But yeah, usually marketing is just allocated as an expense. But I also like to treat it more like an investment fund in a lot of ways. I think a lot of marketers tend to say, "Oh, marketing is an investment." Okay, if marketing is an investment, I'm good with that. But that means I'm just going to have to judge it against other investments. Okay. Um, so let's keep going on the OpEx account here. So filling this account is of a secondary priority compared to paint and people. That one's important. Okay. You have to pay the paint store. You have to pay your people. If you don't pay those two things, you can't paint, and then you can't pay the rest of the people. Okay. So if you need to do budget cuts, I'm looking at the operating expenses first. That's where I'm looking first. A lot of paint company owners, again, they get into trouble because their cost structure is too high, meaning they have too many fixed expenses. They call this, the word for this is being over leveraged. It's when you have too many fixed expenses for the amount of throughput that's coming. Okay. And because of our seasonality in painting, having a high cost structure can be quite burdensome. The weight of a $2,500 lease on a shop in the winter is rarely worth it unless your shop space is absolutely necessary for your operations. If you have massive cabinet operations, then maybe you need that shop, but people are getting very crafty about doing cabinets on site. For small companies, I don't think a shop is really worth it. It adds too much to your cost structure and makes it really difficult to stay in business. If you need space, if your home garage is just not available for storage, I recommend getting a trailer and getting a big chain and bolting that, just hanging it to a tree, a trailer. I also recommend, finding maybe a low cost storage unit. Those are options if keeping equipment in the house or in the van or in a trailer is not an option. A low cost storage unit can really help you out. Um, the thing that I really I harp on about keeping fixed expenses low is ultimately this allows you to stay very nimble and lean, and when you have the extra time and flexibility to do things like market through field marketing where you're actually using your time as opposed to your money, you can actually do really really well financially without carrying too many expenses. Now, the winter spackle gets its name from the compound. We use spackle to fill, uh, holes in walls, and spackle is in fact it's an economics term, and the idea is to use surplus funds in the busy season to fill in the gaps of the slow season. Retailers do this. That's where you get the term Black Friday. That's their day for their numbers to finally go in the black, you know meaning that it's positive as opposed to red, right? Creating a spackle account can really help you to avoid panic, bad decisions, running up credit cards in the winter, taking moonshots to try to, win a job. People do these things, and I've done them, and I've taken those moonshots. The years that I have a spackle in place, it makes me a lot smarter. I can tell you that. Okay, I just make better decisions when I have a spackle in place. So conceptually, this is what we want to be able to do, with our spackle. So if we're looking at this chart here, and I call this the ant and grasshopper method. If you're looking at this chart in the busy season, we end up with a surplus of jobs, and since our fixed costs are at a certain level, then anything that we earn above our fixed cost becomes additional profit. Well, by taking that additional amount and saving it into our spackle account, then we're able to kind of smooth out our expenses across the year, or across the winter. Um, if our fixed expenses create this break even line that is higher than our slow season sales, we would need to build a reserve to account for the dip in work. So in quarters 2 and 3, those are pretty busy and pretty predictable. But the tail end of quarter 3, from about Thanksgiving, to uh, to spring, early March, that's where things drop off, right? From Thanksgiving to the beginning of spring, things dip down, right? And so you want to create a reserve just big enough to cover that gap in this account. Now, there are multiple ways to think about this, and there are multiple ways to think about the slow season. The winter spackle method, like I said, it's really more of an ant and grasshopper method, where you're frugal in the busy season, stashing and preparing away for the winter, like the ant, rather than blowing all your money when you have it, like the grasshopper, which I think it's pretty easy to do that. When you have it, you spend it. A lot of people fall into that trap. A second option, though, is to just have a lower cost structure. Um, you know, don't get roped into the monthly payment deals or subscriptions. Keep it modest. We have our collective membership fee. It's modest, and it includes everything that you really need to run a business. That's intentional. It's to help you keep your expenses low. Um, Avoid racking up too many subscriptions and payment deals. Operate debt free. Live modestly. Okay, there's nothing wrong with living modestly. It's a better life. I was driving out I was at a house this morning. It was a massive house. It was a beautiful house, and I was in a nice neighborhood. I looked across the way. One of the biggest employers in our town was building this giant mansion, and between you and me, I didn't even really like it. I was just like, I couldn't imagine myself living there. And it's not because I don't have goals and ambitions and desires and all of these things, but there's just a matter of something about living modestly that I really appreciate. So essentially, you operate within a cost structure that pretends like your best month is your worst month, so that busy or not, you just don't need a ton of revenue to cover fixed costs, right? Um, the idea here is we're just keeping our expenses low all year, so that even in the slow season, our lowest month sales still going to cover our baseline costs. This works pretty well when you're still fairly small. It does get a little harder as you scale, because you just need extra structures in place that are going to cost money regardless of whether you're producing jobs or not. The third option is the summer expense loading method, and it banks on the idea that you'll be more liquid in the busy season, and so you load your annual expenses during that time. So all of your software subscriptions, you set them to renew in the summer, and you pay annually at a discount rather than monthly. Now, what's nice about that idea is that, once you pay that annual subscription, you've paid for it for the year, and then you don't have to worry about it until next time. But for a lot of them, if you get to that, if you get to that summer point and you're like, oh, that expense is coming up, didn't expect that, then you can temporarily switch back to monthly, and that allows you to just go back to the lower cost. We do this with our collective membership. You could pay you could pay the year and get a discount when you've got the cash, or you can spread it out throughout the year. So, what I would say is just work with your CPA, and also, like, by the way, talk to your CPA, because you could probably get your CPA to have his services paid for within Q2 and 3, right? So you can get really creative, and you could do the same with your lease. You can say, okay, I'm gonna essentially prepay on my lease between quarters 2 and 3, so that quarters 4 and most of 1, I either have a very low monthly payment or no payment throughout that time. Same with vehicle. Pay in advance. You can do this with your home expenses. You can get really you can buy a whole cow, in the summer, and then put it in the deep freeze, and then you've got meat for the year. Go to Sam's or Costco, and make sure that you have all of your trash bags for the full year, and all the toilet paper that you need. Like, be really smart about this. It's a little bit similar to the ant, the grasshopper, where we're loading our expenses so that in the winter time, our burden, our fixed cost burden is much lower. Now, each of these options carries risk. With option one, the risk is whether you're disciplined enough to do it. Option two, I think the risk is being able to operate at all with such a low cost structure. That might not be possible for you. Option three, the risk is that it banks on having a really good summer, which might not happen. So, what I would say is pick the one that works for you personally, or do a combination of all three. What I wouldn't do is have a mentality where you think none of this is going to work for you, because, like, these are literally your options. So you got to pick one of them, and otherwise you're just going to be, you're just going to not have money. Like, you got to pick one of them. So for me, what I like to do is I tend to negotiate summer expense loading for certain things, like mostly software, but I also keep a very low cost structure, right? So I have that combination. Let me keep my cost structure as low as humanly possible, and if I need to incur a fixed expense, let's see if I can negotiate so that I'm paying for it in the summer and I'm paying for it at a discount. But you also have to be careful about that, because you know you got to spread it out across the summer. You don't want all of your expenses coming out on July 1st either. Okay. Now at home, we tend to do this one too. We utilize cash flow buckets and set the money aside for the slow season. But like I said, it all carries risk, right? Um, you know, some years your slow season might hit a lot earlier than expected, and you end up trying to play catch up before you're ready. So just make sure that you pay attention to the trends. You look 3 years back. You see when your seasonal dips are, and you identify ways to keep your cost structure low. Now, here we have the cash flow, or EBITDA. You may have heard this term before. It stands for earnings before tax, before interest, tax, and amortization. Um, for most small companies, don't worry about amortization. Really, we're focused on their earnings before interest and tax. Honestly, if amortization applies to you, you know that. If you have a question of does it apply to me, it's probably not applying to you. Now this is this right here, the EBITDA. It is your free cash flow on your business before you pay. On your profit and loss statement, this is where it gets a little confusing because if you're using QuickBooks, the net profit is your EBITDA. It doesn't split it out further, but we're going to split it out here between taxes and net profit. Say companies like ours usually don't have to deal with the amortization like I said, so we're just not going to cover it now. But let's just talk about this net profit first, okay? And talk about where it goes. Net profit is the taxable income of the business. It also goes to pay on your debt. I mentioned this before. It also pays for your investments in the future of the company, and and that really has to be bargained with the dividends to the owners. Do you invest in the future of the company, or do you pay dividends to the owners of the company or to yourself? Do you make the investment? Do you take it home? What's the best use of it? And one option, of course, is to invest that extra cash flow back into marketing. I like to think about marketing like it's an investment, but not all investments are good. And so, the question is, would I be better off bringing that money home and investing in a strong growth stock with a long track record, like Sherwin-Williams, for example, right? Like, we're a painting company. Do we want to invest in painting? We want to invest in our painting company, but would it be better to invest in? If we really want to invest in a painting company, would it be better to invest in Sherwin-Williams or Berkshire Hathaway, right? That have these long track records. That could be true. When you look at that type of a company like Sherwin-Williams, you look back. Look, they've increased dividends to shareholders for the last 44 consecutive years, right? And that spans 4 or 5 recessions. So I mean, to me, it sounds like a good bet, right? So the question is, can I get a better return on my marketing than I can from just investing it, right? Do I give my money to the Facebook ads and pay for ads, or do I invest in Facebook stock, right? Now there's a question, right? Like, would it actually be would investing in Facebook stock provide a better return than investing in Facebook ads? That's a great question, right? This is why I start with the financials. Marketing, when you're thinking about spending money on marketing, it isn't just about boosting posts. Like if the agencies want to spin it at marketing, if they want to spin marketing as an investment, then we have to analyze and compare the returns of the other investment vehicles that are in place for us. We have to factor in opportunity loss, not just the gain, right? Because anytime you spend money on marketing, you are not spending money on other investment vehicles. So there's an opportunity loss that you have to weigh with the potential gain. A frequent misconception about net profit is that it's what we bring home. It's obviously more than that, which is why I consider owner pay in with operating expenses. From a tax perspective, depending on your entity filing, your owner pay will either get taxed as net profit or as W-2 wages, or a combination of both. But for the purposes of consideration, I'm looking at the owner pay coming in under the break-even line, and I'm looking at dividends to the owners as above the break-even line. So regardless, you're going to be taxed on the net profit. So before I subtract out debt payments and dividends, I separate out a percentage of net profit based on my tax structure. So let me kind of explain this, right? Let me back it up. So when we get cash flow, free cash flow that's coming from the overage of the Spackle account, I'm gonna say, okay, this is the amount that I have, and this is the net profit, but I have to pay taxes out of this. So I'm gonna take a percentage of this amount, and I'm gonna funnel it to the taxes account, whereas the rest is gonna go to the net profit. And maybe I'll put that into another account, and then I get to decide what to do with it. I decide, okay, this is the remaining money. Do I invest a portion of it back into the business? Do I take a portion of it home? What do I do? right? That's always the question. The amount that you save for your taxes, the percentage that you save for taxes, is going to depend completely on your tax structure. So, a lot of small business owners are sole proprietors, or they're LLCs that are taxed as sole proprietors, and that really has one of the highest cost structures. So, or it has the highest tax structure. So, you'll want to set aside between like 30 and 35% of the cash flow, and set it aside into your taxes. Now, C corps, if you're C corp, that makes it pretty easy because it's just a flat 21% corporate tax rate, and all of the officers are taxed separately as employees, and so you'll get an employed paycheck, and all of your tax withholdings and income taxes will just be they'll just be automatically withheld, and then the corporation will be taxed at 21%, which actually gives you incentive to take all of the profit of the company and reinvest it, because when you reinvest it into something like marketing, then it becomes a tax deductible expense, right? So in a C corp during the growth stage, you actually don't really want profit because it just ends up getting taxed, and you want to rely on your income to to for your entire livelihood, and your focus is just on building the value of the business asset. Um, you know, that way you can reinvest all of the net profits back into growth and just make sure that your salary is what you need it to be. Um, Now, the way around a flat salary is actually to pay yourself 100% commission as a sales exempt sales rep. Now, that works if you are in sales and you are doing sales, right? Like you pay yourself 100% commission, as a sales rep. Now, most CPAs, they tell their small business clients to opt for the S corp, and this is where you're going to pay yourself a modest salary, as a W-2 employee, and then you pay yourself dividends that ends up getting taxed at your income tax bracket level. Okay, just what happens is the money passes through as income, and it's taxed at your regular income tax rate. And that ends up usually that ends up being the most favorable option from a tax perspective, but it's also kind of the most complicated. Um, of course, consult a tax professional on all of this. Don't get into trouble. Don't try to try to understand it yourself, but use the help of a CPA, tax professional, to make sure that you're doing it properly. Now, the reason that this conversation is relevant is because at the end of the year, you're going to be faced with a little bit of a math problem, um, that your CPA is going to present you with. If your profits are exceptionally high, they might advise you to find something tax deductible to purchase in order to save a little on taxes. And if that's the case, unless I need like, specific equipment, or my vehicle is like, on its last leg, 9 times out of 10, I'm probably going to go with marketing. So long as all of my other home needs are met. If my home needs aren't met, then I'm just going to meet my home needs and pay the taxes. So this is where calculating your break even really comes in handy. You make a budget, and so you know what you need to take home, but how do you factor all that other stuff into the mix? Okay, and that's where um, break even analysis comes in handy. So having this financial plan with the buckets, it's really great, but it is inherently reactive unless you know what to do with the numbers. Meaning, up until now, we've really just learned how to watch the money come in and move it around, but we don't really know what to do with it to grow our business or improve our lives. So let's get a little more advanced here and go over how to calculate the break even analysis. It starts by calculating your contribution margin. You might recall from earlier in the video, we called the money left over after you paid taxes I'm sorry, if after you've paid for your COGS, the money left over after you've paid for COGS, that's called the contribution margin. Or it's, you can consider it the gross profit margin that will be used to contribute to your operating expenses. That's why we call it the contribution margin. We can look back at our records and see what that is, what this is historically. I recommend looking at your own records rather than comparing to industry benchmarks. Okay, let's put that one in quote, industry benchmarks. We see a lot of industry benchmarks. A lot of people just make stuff up and say this is the benchmark. Um, you want to look at your own stuff because you don't want to create an unrealistic situation based off of somebody else's numbers from a different state with different wage rates, with different taxes, different cost of living. Nor do you want to sell yourself short by leaving margin on the table. So do your own numbers, okay? I'm teaching you how to do this. Just like pause it, rewind, write the notes down, okay? Figure this stuff out. So you start with historical sales and you subtract your variable costs for the period you're looking at. You can look back 6 months, a year, or even 3 years, which I would say is preferred. If you have 3 years, look back 3 years. This gives you your contribution margin. In this example, we'll take sales of 300,000 and COGS of 200,000, and the difference is a contribution margin of $100,000, meaning that you have 100K to contribute to your operating expenses, which includes a base salary for yourself. Okay, so now you may be looking at this and think, as that's not a lot left over. This is just an example. Okay, again, you create an amount that is the right amount for you. You make your own benchmarks and compare your benchmarks to yourself. So next, we want to know the contribution margin percentage. Start here by dividing your contribution margin, which is found in that previous equation that we made, and then divide that by your historical sales. This gives you the percentage, and in this example, it's 33%. Okay. Again, this is an example. It's not about right or wrong. This is not the target that I'm setting for anybody. Create your own. Now we're going to calculate our break-even sales, or in other words, the amount of sales we need for the year to cover our operating expense. If you've done a good job of budgeting, you know how much money you need to cover fixed costs. In this example, let's say that looking at the year ahead, our fixed costs, including base salary, is going to be $150,000. Now, to figure out our sales goal to break even, we'll take the 150K and divide it by the contribution margin percentage of 33%, giving us a break-even sales of 454,545. Now, notice that in previous years, our contribution margin was 100,000 and that we only needed $300,000 in sales to cover our expenses. But an increase in 50K of expenses resulted in a 52% increase in needed sales. That makes you kind of think twice. So let's look at another example here where we're actually going to reduce expenses significantly. Here we're cutting expenses by $20,000, hopefully not our base salary, but now we only have a fixed cost of $80,000. We'll divide that by the 33% and we get a break even of $242,000, which means that we can keep our same base salary while reducing sales by $58,000. Now, why would we want to do that? Well, reduced sales would require reducing your labor force, which may allow you to justify releasing an underperforming employee or reducing your management burden while maintaining the same income level. But keep in mind that this is just break even. And so, if you're looking at $80,000 and you're thinking, that's not the base salary that I want, I'm talking about a base salary. I'm not talking about base salary plus profit. This is just your break even amount, okay? And by the way, you still have to pay taxes on that. So I'm just talking about a base salary, not including profit targets, okay? And so you might give yourself a modest base salary, especially if you're an S corp, and then you're going to be relying on creating a target profit to increase your income beyond the W2 wage. Okay, so let's go ahead and add the profit. To add profit, we just insert this into the fixed costs and plan the profit into our total sales target. So here in this example, let's presume we have achieved the best of both worlds and reducing expenses by 20,000 while maintaining our base salary and increasing our profits by 70,000. Notice that the total sales figure is the same as the first example where fixed expenses were 150K. That is, of course, me just making the math easy for my example. But it shows that when you have your contribution margin percentage dialed in, you can easily calculate sales goals based on expenses and desired profits. What's really fun is figuring out whether to invest in a marketing campaign or not based on these numbers. Because now you're not only examining what the expected profit would be, but you're also comparing the investment to the other investments that are available. Again, do you invest in Facebook ads, or would it be better to invest the amount saved from not buying ads and buying Facebook stock instead? And as of this recording, with all the Meta layoffs passing through, income to profit, it's something that would give me pause. So that is that's the business seminar today, business cash flow. I hope this was helpful. I recommend going back, rewatching the parts that went a little fast. Okay, we broadcast this live, and then we keep it up on YouTube, on the YouTube channel. So make sure that you are subscribed so that you can continue to learn these things and continue to go back and watch and take notes, and especially if you're currently just listening on the road, or you're on the job site. If any of this, because again, it's numbers, and that's, numbers, they go over my head. I would have to, if I was listening to this the first time, I would have to go back and watch it again. There's nothing wrong with that. We put this content out for our collective members, but we make it free to the public. If you are a high quality professional painter and you don't have a strong brand, either you don't have one or you don't have one you're proud of, consider joining the collective. The Craftsman Painter Collective is a community of professional painters rallying around a common brand, lifting each other up, supporting each other, making each other look good, and it is a place to get better at business. So go to craftsmanpainter.com/collective to learn more information. Don't forget to check out our our sponsors, some of the folks that we partner with, and we have links in the comments. Like and subscribe. Till next time, my name is Torlando Hakes. Thank you for watching.